Welcome to my Chapter 5 review for final part 2, where we're looking at inventory done under the perpetual method. And in this pencast, I want to start by looking at adjusting entries. Can't spell this morning. What adjusting entries might be required. So we've moved clear to the adjustment process. To use an example, let's say we had recorded all of our transactions into the inventory account for purchases and sales during the month, and we currently have a balance of $100,000 at the point of adjusted trial balance. So this is an adjusted trial balance number, and we go out and we do a physical count on our inventory, and we notice that we have $99,500 when we total it all up. What's happened? Well, apparently we've had an inventory shortage occur. How do you get an inventory shortage? Sometimes inventory gets broken, damaged, or thrown away. Sometimes it grows legs and walks off. It really does. I've heard that, and I've seen evidence of it. I've never seen it actually walking, but it has disappeared on me before. So what number should show up on your financial statements for inventory? Would it be the $100,000 or would it be the $99,500? Well, you would want to show it correctly. The journal entry to record a shortage of inventory that's small in amount is to debit cost of goods sold and to credit inventory. And the reason we debit cost of goods sold for small amounts is we figure shortages are normal parts of holding inventory. And so when we have one, we'll just increase the cost. So the adjusting process is to take a physical count and adjust the inventory balance from what shows on the adjusted trial balance to match what the physical count is. Gets buried in cost of goods sold if it's an insignificant amount. If it's a significant amount, why, you'd probably be filing an insurance claim and having an investigation. That's way too complicated for a morning. So let's move on. So, closing entries. Seriously, you'll look at those ideas in intermediate classes. Let's look at closing entries next. Skimming along, aren't we? I want to review all 4 closing entries with you, because experience tells me that you could use a review of them. Closing entry number 1. We used to say close your revenue accounts, but I'm going to change that to be close your credit balance, temporary accounts. And remember, your temporary accounts are your income statement accounts or your draws accounts. Close your temporary accounts that have credit balances for your first closing entry. The second thing that you would do would be to close any, we used to say expenses, but I'm going to change that now because we have more debits than just expenses. So I'm going to say close debit balance, temporary accounts. And that will be your second closing entry. Then your third closing entry would be to close income summary. Sometimes you have a hard time remembering the name of this account, but it's where you summarize net income. So kind of an easy one if you think about it. Close income summary into the capital account. And the fourth closing entry is to close draws into the capital account. At the end, capital has been updated. So how does the entries that we practice for purchasing and selling inventory affect these closing entries? Well, it affects the first one because now we won't have revenues. We'll have sales. Sales has a credit balance, so we'll debit it and put that in income summary. I'm not going to really use numbers here. I'm just going to point out what the entries would be. So debit all sales and any revenue accounts if you have any besides that, and move that into income summary. So now income summary has increased for your income. Now we're going to close our debit balances into income summary. And in the past, that's only just been our expenses. And don't just write expenses and total it. You have to close expenses and account on at a time. So on the final, you list them out. Don't fall into the trap. You'll lose points. So list out your expenses and close them. And you're also going to have a new expense, which I am going to list. Cost of goods sold expense needs to get closed here. And that came in new with this chapter. You'll also have a couple of contra revenue accounts with debit balances. Sales, returns, and allowances have debit balances. You'll need to close those, as does sales discount. So that's why I said close debit balances. We have a couple of contra revenues, sales, returns, and allowances, and discounts being closed here. Well, now into the account income summary. The name being very reflective of what happens here. You have transferred your revenues into here with your first closing entry. You have transferred all expenses and contra revenues in here with your second closing entry. So what sits in income summary is what its name says, net income. And it's time to close that. If it's net income, we'll have a credit balance, so we'll debit income summary for it. Can it have a debit balance? Yeah, if you lost money in the period, you could. Let's hope you didn't. Debit income summary and transfer that into the capital account, because net income belongs to the owner. And then the last closing entry is to transfer into capital account the balance in the draws account. Draws has a debit balance, so we will credit it. And these entries are what makes the owner's capital account agree with the statement of changes in owner's equity and the number on the balance sheet. It has a beginning balance at the beginning of the period. It goes up for net income. It goes down for draws. And then, by golly, it has an ending balance, which hopefully agrees with your financial statements. So, yay, in this short pencast, under 10 minutes, go girl. We looked at how inventory affects adjusting entries and how it affects closing entries. In my final pencast for Chapter 5, I will look at how it affects income statement in more detail, looking at the single step and the multi-step approach, and look at ratio analysis. Thank you so much for joining me. Off we go.